Hi, I'm Steve LaFrance with Blakely Financial, and I'm summarizing the past 3 months in about 3 minutes. At the risk of being repetitive, markets were unsettled and volatile during Q3. The trend changed multiple times as traders reacted to data and repositioned portfolios. The S&P 500 finished down 4.9%, while the 2-year Treasury yield reached levels not seen since 2007. Data showed inflation pressures ease against a backdrop of falling energy and gas prices since peaking in early June. Markets cheered these inflation declines, but the Fed wasn't finished with its tightening efforts to prevent inflation from becoming entrenched. Figure 1 compares the current round of rate increases against prior tightening cycles, with the Fed now projecting to end 2022 at 4.4%, implying another 1.25% of rate increases by year end. If there was ever any doubt, the Fed is taking the inflation threat extremely seriously. The path of economic growth and the strength of the U.S. economy were concerns entering Q3. Data showed the economy slowing after a period of robust growth during the pandemic recovery, and analysts couldn't stop talking about the definition of a recession and when it might happen. In our view, the current environment is even more unique due to the nature of the global pandemic, impact of multiple rounds of fiscal and monetary stimulus, and record inflation readings. And then it's important to remember that recessions come in all shapes and sizes with no predetermined path. It's simply too early to determine the magnitude of a continued slowdown or how long it may last. Corporate earnings were another concern. Companies benefited during the recovery thanks to low rates and robust pent-up demand. Pricing power allowed companies to pass through increased costs, which led to higher profits. Analysts still expect earnings growth to remain positive but slow to 2.6% year over year this quarter, after achieving 9.3% in Q1 and 6.3% in Q2. Figure 2 tracks the up and down S&P 500 during Q3. Expectations for a shorter tightening cycle propelled stocks approximately 14% through mid-August, then swiftly reversed after a stubborn inflation report followed by aggressive Fed commentary. Growth stocks started to find their footing, but still trail value, and international markets continue to face headwinds, including Europe's energy crisis, China's COVID-0 policy, and a strong dollar. It's been a difficult year for both stocks and bonds. This sell-off has been particularly challenging because bonds, which historically act as a hedge, have traded down with stocks. During volatile market environments such as this, it is helpful to take a step back and look at the bigger picture. Figure 4 graphs cumulative economic expansion and decline since 1950. The average recession lasted 13 months with a negative 2.3% GDP. In contrast, the average expansion lasted 57 months with a cumulative 21.5% GDP growth. And we cannot time when these events begin or end. Volatility is the price of admission to investing in economic progress, technological innovation, increased productivity, and earnings growth. Markets experience both good times and bad, and the bad times can test even the most patient investor. It's easy to sell and go to cash to relieve anxiety, but this often creates a bigger issue. When do you re-enter the market? Lengthening your time horizon places the odds in your favor. Put simply, it pays to be a long-term investor. Again, we thank you for your trust, your confidence, and your patience.